Just last week, the Federal Reserve announced they were raising short-term interest rates by 75 basis points. This announcement is just 1 month after Chairman Jerome Powell said the central bank was not actively considering raising rates 0.75%. I'm Chris Parrish, Chief Investment Officer at Oak Harvest Financial Group in Houston, Texas, and this is our investment team's midweek release where we examine a news item, headline, or story making the rounds from publicly available sources, and we ask, is it news or is it noise for your investment portfolio? This week's topic is the Fed raising short-term interest rates by 75 basis points. On Wednesday of last week, the Federal Reserve raised the Fed funds rate by 75 basis points in order to fight inflation. It was only a month ago when they said they were not considering that much of a raise, but after Friday, June 11th's Consumer Price Index report showing inflation rising faster than they expected, they changed their tune and leaked a 75 basis point interest rate increase to the press early in the week. Many TV analysts expressed alarm at the size of this move, stating it's the first time since 1994 the Fed has made such a big move. Bringing up a date of almost 30 years ago, as if it was so long ago, it must have been bad for the markets. I don't know if it will or won't be bad for the markets this time over the next 6 to 12 months, but the S&P 500 is already in bear market territory, and hiking short-term rates into an economic slowdown to combat inflation, well, we'll see. However, I do know back then in 1994, Alan Greenspan, hiking rates by 75 basis points, did exactly what it was supposed to do. He raised rates 7 times by 3 to 6% in 1994. In November of 1994, Alan Greenspan, the then chairman of the Federal Reserve, announced a rate hike from 4.75% to 5.5%. Under Greenspan, the Fed had slowly been tightening the screws. He was able to effect a soft landing in the economy by tightening monetary policy and slowing inflation to keep the economy from overheating. In 1994, stocks initially dropped minus 10% during the first half of the year as inflation rose early in the year. However, stocks ended the year only slightly negative for the whole year, down around minus 2%. Back then, the Federal Reserve was able to avoid a recession, and stocks rebounded by 34% in 1995. Yes, you heard that right. They rallied by 35% over the next year. What's more is after the rate hike in November 1994, stocks dipped slightly before rebounding ahead of another rate increase in February 1995, according to data from CFRA research. Here's that historic chart from 1994. Viewers, let it sink in for a bit. Will history repeat? I don't know, and there's no guarantee in the stock markets. However, investor sentiment, positioning, and expectations drive stock prices well in advance of what most readers are seeing on TV or reading in newsletters. And many of the alarmist headlines often leave out the punchline because it doesn't fit their bias. In this case, those stories had a negative bias. The scare tactics of bringing up 1994 as a data point? Yes, it was news because back then, the 75 basis point increase by the Fed marked the lows in the stock market the next 15 to 18 months, not the highs, as many on TV would lead you to believe. At Oak Harvest, we think our clients are best served by us helping them plan for their future needs instead of focusing on the past. The future is always uncertain, and that's why our advisors and retirement planning teams plan for your retirement needs first and your greed second. Give us a call here at Oak Harvest to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here at 877-896-0040 and schedule an advisor consultation. The whole team here at Oak Harvest is here to help you on your financial journey into and through your retirement years. I'm Chris Parrish, and from everyone here at Oak Harvest, have a blessed week.